Two people, same city, same age, both 28. Both just landed their first real job. Both opened a brokerage account on the same Tuesday afternoon in the same October, depositing the same $300 a month into the same S&P 500 index fund. Now it's 30 years later. The first person is sitting at a kitchen table with a cup of coffee, watching the number in their account clear $600,000. They're 58. They haven't done anything spectacular with their life financially. No crypto windfall, no inheritance, no six-figure salary. Just $300 a month for a really long time in a boring index fund. They look at that number and feel something close to disbelief. The second person is also 58. They also invested $300 a month for a while. But somewhere around year 4, the market dipped, they got nervous, pulled everything out, and then life happened. Car, upgrade here, a pause there. They told themselves they'd get back to it when things stabilized. They check their account today and have about $41,000. Same starting point, same amount, same investment, 30-year gap of $559,000. My name is Nick, and I've spent a genuinely embarrassing amount of time staring at compound interest tables so you don't have to. If you've ever looked at your investment account after 2 years of consistent contributions and thought, is this actually doing anything? Today we're going to fix that. Because there's a specific framework that explains exactly why compounding feels broken in the beginning, when it turns the corner, and what you need to do to be in the room when it does. It's called the 7-5-3-1 rule. Let's get into it. The entire difference between those two people fits in a single sentence. One of them understood what a compounding curve actually looks like, and one of them didn't. And once you see it, you cannot unsee it. The reason most people abandon compounding early isn't laziness. It's that nobody ever shows them the curve. They get told, invest early, be patient, it'll compound. And then they watch their account grow by $200 in a month where they contributed $300, and they think they've been lied to. You haven't been lied to. You've just been shown the destination without the map. So here's the map. Take $10,000 invested at 10% annually. After 10 years, you've got $25,937. After 20 years, $67,275. After 30 years, $174,494. After 40 years, same $10,000, same 10%, $452,593. Here's the number that should stop you cold. Like in that final decade alone, years 30 through 40, your account grew by $278,099. That's more than 62% of all the gains from 40 years of compounding arriving in a single decade. The first decade, $15,937. That's 3.6% of the lifetime gains. 3.6. The first 10 years of patient, disciplined, by-the-book investing generates 3.6% of the total return. The last 10 years generates 62%. The early years aren't just slow. They're structurally, mathematically, unavoidably slow. And the people who build real wealth are the ones who understood that before they experienced it, not after. Warren Buffett was worth about $1 million at age 30. By 50, roughly $300 million. He became a billionaire at 56, and approximately 99% of his current net worth, over $140 billion, accumulated after age 50. Not because he got smarter after 50, because the snowball he'd been rolling since age 11 finally hit the steep part of the hill. He described investing as finding wet snow and a really long hill. The wet snow is a good investment. The long hill is time. Most people never give the hill a chance because the first 7 years look like a flat parking lot. Here's why that happens. Your brain does not naturally process exponential growth. Researchers call it exponential growth bias, and roughly 1/3 of people perceive compound growth as essentially linear, meaning your brain looks at a compounding portfolio, draws a straight line, and concludes this is going nowhere. It's the same reason that when you ask someone if a lily pad doubles every day and covers a lake in 48 days, when does it cover half the lake? Almost everyone says day 24. The actual answer is day 47. The lake is less than 1% covered until day 24. and then it finishes in the next 23 days. Your investment account is that lily pad. You're just not at day 47 yet. The first number in the 7-5-3-1 rule is 7, the minimum investing horizon before compounding starts to feel real and before you've earned enough evidence to stop running on pure faith. It maps almost exactly to what the rule of 72 predicts. Divide 72 by your annual return and you get your doubling time. At 10%, that's 7.2 years. This rule, by the way, is 530 years old, invented in 1494 by an Italian mathematician who was apparently close friends with Leonardo da Vinci. And the fact that a Renaissance-era math trick is still the single most useful thing in a modern investor's toolkit says quite a lot about how dramatically the financial industry has overcomplicated something that does not need to be complicated. The 7 is really saying one thing: don't quit before your money has doubled even once. Because that first doubling is the reference point your brain is waiting for. Before it, you're running on faith. After it, you have evidence. The data backs this up. Looking at rolling return windows in the S&P 500 going back to 1926, if you invested for any random one-year stretch, you had about a 74% chance of making money. Stretch that to any random 7-year window, and your odds jump to over 95%. Every single 7-year rolling period in S&P 500 history has produced a positive average annual return. Like everyone. The market has survived 2 world wars, a Great Depression, 14 recessions, the dot-com implosion, the 2008 financial crisis, a global pandemic, and a brief period where people were genuinely buying JPEGs of monkeys for $500,000. 7 years has always been enough time to come out ahead. The market is deeply, profoundly unkillable. The investor, unfortunately, is much more fragile, which is exactly what the next 2 numbers address. 7 years is the floor, not the destination. The 7-year mark is just the point where you've earned the right to believe in what you're doing. Commit to it. Not because it's when the money gets good, because it's when you get good at staying invested. But committing to 7 years doesn't matter if a single bad year wipes out your base before compounding has anything to work with. All right, that's what the second number is about. The second number is 5. Diversification across 5 types of assets that behave differently from each other. Not the vague spread your eggs advice your uncle dispenses at every family gathering like he invented it. Actual structure, here's why it matters. In 2021, a specific type of investor felt like a genius. They'd concentrated heavily in high-growth tech during the pandemic run-up. Some doubled, some tripled, then 2022 happened and some of those positions dropped 60%, 70%, 80%, the math problem nobody mentioned. If your portfolio drops 60%, you don't need a 60% gain to recover. You need a 150% gain. While you're running that rescue mission, the person with a diversified portfolio is quietly compounding. Think of your portfolio like a Formula One pit crew. The broad market index funds are your main driver, doing most of the work, most of the time, returning around 10% annually going back to 1926. They should be 40 to 60% of your portfolio. Dividend-paying stocks are your backup systems. Companies like Coca-Cola that mail you a check every quarter, which you reinvest to buy more shares, which earn more dividends. It's compounding running a second shift. Small cap and international holdings are your performance upgrades, more volatile, more upside, adding percentage points over decades that turn into hundreds of thousands of dollars. And the defensive assets, like bonds, treasury bills, are not there to win the race. They're there to make sure you don't crash out on lap 4 and never finish. Because here's the thing about bonds, nobody tells you until it's too late. The bonds don't make you rich. If they make you the person who doesn't panic sell their stocks at the bottom of a crash because they have something else in the account that isn't on fire. When the market drops 30% and your bonds are down 5%, you feel rattled but not destroyed. You keep contributing, and that staying in during the exact moment everyone else is leaving is where the compounding gap between investors actually gets created. You don't need to obsess over exact percentages. You just need all 5 crew members in the car and to not hand the wheel entirely to one of them. Before I describe these three phases, I want to say something directly. If you've ever pulled money out of the market during a crash, paused contributions because your account looked flat and you lost faith, or quietly stopped investing because life got expensive, that is not a character flaw. That's a completely predictable human response to a system that withheld the map. Nobody sat you down and explained what the first 7 years are supposed to look like. So, of course, people bail. The question is whether you know it now before the next time these phases show up. Phase 1, doubt. This happens in the first 2 or 3 years. You open the app one Sunday morning to find that after 18 months of $300 monthly contributions, your account has grown by an amount you could cover with a decent overtime shift. Something in your brain starts doing alternative math, calculating what you'd have if you just put those contributions toward your car payment instead. The number is actually kind of close, which somehow makes it worse. Then, because you're apparently a masochist, you find yourself thinking about that friend's startup you passed on. The numbers aren't dramatically different. That's the part that keeps you up at 2 a.m., not the market. This phase is manufactured entirely by the flat early section of the compounding curve. You are not doing anything wrong. Correctly and impressively, just don't overlap for a while yet. Phase 2, frustration. This arrives around year 3 or 4. You've started calling yourself an investor, which felt good when you said it, but the account balance doesn't quite match the identity. You've also developed opinions about Fed policy. You've used the phrase macro environment in an actual conversation. Your account has $18,000 in it. The frustration phase is almost always the phase right before returns start to look interesting. Like the exponential curve is bending. You just can't see around the corner yet. It's turning off the oven 30 seconds before the food is done. Phase 3, panic. The market drops, not a little. 30%, 37% the way it did in 2008, the way it did in March 2020 when the S&P fell 34% in 23 trading days, the fastest crash of that magnitude in history. Your account drops below what you put in. You open the app, see it, close it immediately, then open it again 6 minutes later like it might have changed. Some people start making a spreadsheet tracking their daily losses, which is the financial equivalent of repeatedly pressing on a bruise to see if it still hurts. It does. Stop making the spreadsheet. Dalbar, the financial research firm that has tracked investor behavior since 1985, found that in 2024, the average equity fund investor earned 16.54%, while the S&P 500 returned 25.02%. An 8.5 percentage point gap, not from picking bad stocks, but from emotional timing decisions. Every year since 2010, the average investor has underperformed the market. Every year, Dalbar publishes essentially the same report. Every year, it keeps not helping. 2024 was the 15th consecutive year of the same finding. The 2008 collapse was fully recovered by 2013. The March 2020 crash fully recovered by August of the same year, 5 months. If you sold in April 2020, you locked in a loss and missed the entire recovery. If you kept buying, you were purchasing shares at a 30% discount and were whole again by summer. Panic doesn't protect you. It permanently transfers your potential gains to whoever was patient enough to buy what you sold at the bottom. Doubt means you're early, not wrong. Frustration means the curve is about to bend, and panic means the market is on sale. And the only investors who get hurt are the ones who leave the store. And if you can survive all 3 of those phases, which you now can because you know they're coming, is our throats, there's one final lever that quietly doubles the entire outcome. Most people never pull it. It takes about 4 minutes once a year. The final number is 1. 1 annual increase in your contribution amount. This sounds like a footnote. It is not a footnote. You invest $300 a month at 8% annually for 30 years. Final balance, roughly $408,000. Now, take the same scenario, but every January you bump your contribution by 5%. Year 2, $315. Year 3, $331. By year 10, you're at $489 a month. And the increases are gradual enough that you barely feel them. With that one adjustment, your 30-year ending balance jumps to approximately $787,000, nearly double. Same starting point, same return rate, same market, a 5% bump that costs you $15 in year one. Here's the part that should break your brain. A 5% increase on $300 a month is $15. That's one Chipotle burrito bowl per month. And I'm not doing the avocado toast thing, I'm just saying it's literally one meal that over 30 years becomes $379,000. The burrito bowl does not become $379,000, to be clear. The invested $15 does, but the psychological gap between skipping one meal and building $379,000 in retirement wealth is apparently wide enough that most people never make the connection, which is why I'm here. Charles Schwab found that investors who increased contributions by even 1% annually ended up with 25% more wealth after 20 years versus those who kept contributions flat. Nobody has ever impressed a date by mentioning they auto-increase their index fund contribution every January, but in 30 years that person can afford a very nice dinner. Several, actually. The mechanism that makes this work, automate it. Set the reminder now. Better yet, set it up automatically with your brokerage. Because the version of you who has to actively decide to move money every January is occasionally going to have a bad January and skip it. The version of you whose account quietly bumps on its own is building $379,000 while sleeping through that bad January. Meet Marcus and Diane, both 32, both start investing $400 a month. Same 8% annual return, zero starting balance. Marcus follows the 7531 framework, commits to the timeline, diversifies, recognizes the emotional phases when they arrive, and doesn't act on them. Increases his contribution 5% every January. Diane also invests $400 a month. She's not reckless or financially irresponsible, she just doesn't have a structure. In year 3, during a market correction, she moves half her money to cash and waits 11 months for things to settle down. She never increases her contributions because every year something comes up and the amount stays at $400. At 42, Marcus has $73,000. Diane has $52,000. Noticeable, but not alarming. By 52, Marcus has $229,000. Diane has $121,000. Now it's uncomfortable. By 65, 33 years from the same starting point, Marcus has approximately $1,100,000. Diane has $389,000. Same person, same life, $711,000 apart. Here's the number inside that number. Over 33 years, Marcus contributed roughly $430,000 of his own money. Compounding added $670,000 more than Marcus himself put in. His money did more work than he did. Diane contributed roughly $158,000. Compounding added $231,000 for her too. The market was equally generous to both of them. The difference is that Marcus gave it more to work with for longer without interrupting it. Diane's $389,000 at 65 isn't a spreadsheet figure. It's a phone call to her daughter saying she needs to keep working another 3 years. Marcus's $1.1 million isn't a spreadsheet figure either. It's him declining a project at work, not with drama, just a polite no, because he genuinely doesn't need it anymore. The money gap becomes a freedom gap. And the freedom gap is the thing that actually matters. That $711,000 difference wasn't caused by one catastrophic decision. 11 months of cash sitting in year 3. Flat contributions for 33 years, missing the final decade's explosion because the foundation wasn't there. Marcus didn't do anything heroic. He just didn't interrupt the machine. Charlie Munger put the entire 7531 rule into one sentence. The first rule of compounding is to never interrupt it unnecessarily. That's not inspiration. That's the instruction manual. The financial industry profits from complexity. A person who understands the 7531 rule automates their contributions, increases them 5% a year, and holds a diversified portfolio without touching it is genuinely terrible for business. They don't need advice. They don't need products. So nobody hands them this framework. So that's what today was. Set a non-negotiable 7-year floor. Write the date somewhere visible. And before that date, your job is simply not to quit. Check your portfolio against the 5 categories. Confirm you're not 90% in one thing, that you have some defensive exposure, and that you're not ignoring international markets. A target date retirement fund does this automatically if you'd rather not think about it. Automate your contributions so the monthly decision doesn't require your approval. Write down your plan for each emotional phase right now before you need it, because when the market drops 30% and your logic center goes offline, I'll see how I feel is not a plan. It's a donation to whoever's on the other side of your panic cell, and schedule your annual 5% contribution increase on a specific date every year without exception. That's it. The whole thing. Profoundly, aggressively, almost offensively boring. No ticker to watch, no moves to make, no moment of cleverness. Compounding doesn't care how smart you are. It doesn't care about your salary, your degree, your spreadsheets, or how many finance podcasts you've queued up. It cares about exactly one thing, whether you left it alone long enough. The people who end up with the extraordinary late years aren't financial geniuses. They're just the people who were too boring to quit. Go be boring.